Hey guys, welcome back to another video. Today we'll be talking about the precedent transactions analysis, and this is Chapter 2 of the Investment Banking Valuation, Leverage Buyouts, and Mergers and Acquisitions, a second edition textbook by Joshua Rosenbaum and Joshua Pearl. And this is a fantastic textbook, and I really loved learning from it. It's very helpful for students who are entering the investment banking or equity research industry. It's a great prep for interviews, and at the same time, it covers everything that you need to know about the comparable companies analysis, the precedent transactions analysis, which we'll talk about today, the discounted cash flow model, the leverage buyout model, everything that you need to know about that. And so it's great for entry to intermediate level kind of students. So fantastic resource. And so in today's video, we're going to be talking about the precedent transactions analysis. So let's get started. So the precedent transactions analysis, like comparable companies analysis, employs a multiples-based approach to derive an implied valuation range for a given target. It is premised on multiples paid for comparable companies in prior M&A transactions. The selection of an appropriate universe of comparable acquisitions is the foundation for performing precedent transactions. As with trading comps, it is often challenging to obtain a robust universe of truly comparable acquisitions. It is not uncommon to consider transactions involving companies in different but related sectors that may share similar end markets, distribution channels, or financial profiles. As a general rule, the most recent transactions, i.e. the ones that have occurred within the past 2 to 3 years, are the most relevant as they likely took place under similar market conditions to the contemplated transaction. So at the end of the day, there are a lot of similarities between the comparable companies analysis and the precedent transactions analysis, but there are some key differences. I think the deal dynamics are really different, but when you're looking at the precedent transactions and you're determining which ones to include in your analysis and which ones not to, there are a lot of business and financial profile characteristics that are very similar to the analysis when initially selecting the universe for the comparable companies analysis. So I do recommend that you watch chapter 1 as well, where we talk about that analysis, because that will provide a lot more information on how to really select the best transactions, because there are tons and tons of considerations about the customers that they serve and how they're exposed to different cyclicalities from a demand and supply perspective. Okay? Now, under normal market conditions, transaction comps tend to provide a higher multiple range than trading comps for two main reasons. One, a control premium is paid because at the end of the day, you're acquiring a business versus in the comparable companies analysis, you're only considering the current market value of the company. And two, strategic buyers can realize synergies in these transactions, which raises the price tag. And so we'll talk about what strategic buyers are. But at the end of the day, when you are acquiring a business, that multiple that is paid, the enterprise value to EBITDA multiple, which we'll talk about, those multiples are significantly higher than the comparable companies analysis. And so you need to account for those differences to understand why there is such a premium paid. Okay, now let's talk about strategic versus financial buyers. A strategic buyer is a company that provides products or services and is often a competitor, supplier, or customer of the target firm. They can always also be unrelated to the target's industry, but recognize the strategic potential for synergies reflected in the profit and loss line. The financial buyer includes private equity firms, venture capital firms, hedge funds, family investment offices, and ultra-high net worth individuals. These firms and executives are in the business of making investments in companies and realizing a return on their investments. So overall, their motivations and their objectives in the short to long term are very different. And so you need to understand and define when you're looking at precedent transactions, was it a strategic buyer or a financial buyer? Now, what are the steps necessary in conducting the precedent transactions analysis? Well, first, you select the universe of comparable acquisitions. You then locate the necessary deal-related and financial information. You then spread or produce the key statistics, ratios, and transaction multiples. You then benchmark the comparable acquisitions by taking their means and medians, and then finally determine the valuation for your client or for yourself, and set a range. So it shouldn't be a specific number, but a range of between one multiple and another multiple. Okay. So step 1, select the universe of comparable acquisitions. The identification of a universe of comparable acquisitions is the first step in performing transaction comps. This exercise, like determining a universe of comparable companies for trading comps, can often be challenging and requires a strong understanding of the target and its sector. Consider the following sources: M&A databases, target M&A history, revisit the target's comparable companies, search merger proxies and fairness opinions, and review equity and fixed income reports. So there are a lot of sources of information and depositories of information where you can really determine, okay, which precedent transactions should I include in my analysis. And so these are the sources which you can search to really add to your analysis. Now, once an initial set of comparable acquisitions has been selected, you need to gain a better understanding of the specific circumstances and context for each transaction. These can impact their weighting in the precedent transactions analysis. So the key considerations and really the most important component, because similar to the comparable companies analysis, you're choosing precedent transactions that you're comparing this current transaction to. If you are comparing them to the wrong transactions or unrelated transactions, then your analysis is going to be off and it's going to be useless. That is the same as with comparable companies analysis, where if you're comparing them to different comparable companies that are outside of their industry, not related to your target company, then the overall final weighting and final valuation will be off and useless. So some key considerations are the market conditions in which the transaction was completed in, the deal dynamics, whether it was a strategic or financial sponsor, the motivations, were they selling a non-core asset, a financial asset, or was it a strategic buyer that was interested in buying them, the sale process and the nature of the deal, was it a merger of equals, and also the purchase consideration, which we'll spend a lot of time on that as well. Okay. What about the market conditions? Market conditions refer to the business and economic environment as well as the prevailing state of the capital markets at the same time of a given transaction. These conditions directly affect availability and cost of acquisition financing and therefore influence the price an acquirer is willing or able to pay. They also affect buyer and seller confidence with respect to undertaking a transaction. So the market conditions is very, very important. If I'm currently in 2012 recording this video, and if I were to compare a potential transaction today to one in 2009, post the great financial crisis in the United States, then it would really be unfair from a market condition perspective. So if you're comparing a transaction in a boom phase of a cycle, then you should be comparing that to other boom phases. You can't be comparing it to a trough where a transaction was executed and the market was just recovering from a recession and the buyer was not willing to pay as much. So market conditions are very big influencers of the premium paid for a company. From a deal dynamic perspective, there are specific circumstances of a given transaction. Was the acquirer a strategic buyer or a financial sponsor? What were the buyers and sellers' motivation for the transaction? Was the target sold through an auction process or a negotiated sale? The highest bidder or one to a company that they themselves are comfortable selling to? Was the nature of the deal friendly or hostile? Usually a hostile deal charges more of a premium because the company itself is protecting itself from that acquirer, and so they'll only give in to a higher premium. And what was the purchase consideration? Was it a mix of cash and stock, or was it just pure stock or pure cash? Okay, so let's look at that strategic versus financial buyer. So we defined what a strategic and financial buyer are, but what are the key differences between the two of them? Well, a big difference is how they evaluate the target business. For the strategic buyer, they're adding that business to their existing business lines. So the synergies that they will realize are part of that acquisition. Whereas a private equity company, they don't have, a steel manufacturing plant. They're acquiring a steel maker. So what they're doing is really they're just evaluating the business as a standalone entity. At the same time, how they determine the investment merit of the industry. So for the strategic buyer in that same industry, they're very familiar with the industry. Whereas with a private equity company or financial sponsor, there will be a bunch of analysts that do research on that industry, but they're not as familiar. From a back office perspective, number 3, that's another big consideration. So the strategic buyers, when you acquire a steel company as another steel company, you're now going to have 2 accounting departments, 2 HR departments, 2 information technology departments, right? So from a back office perspective, you can probably cut on back office expenses and therefore once again realize more synergies and at the same time really project to see, okay, we're going to be able to handle the data needs of this new acquisition. Whereas with a financial sponsor, sponsor, they're not integrating it into an existing business. They're just adding ownership, right? So they have their ownership, and they're going to maybe change some management, but they need to evaluate back office more. So there's much more analysis for the financial buyer than the strategic buyer when it comes to back office infrastructure. Number 4, the impact of the investment horizon. Financial buyers are short-term to medium-term investors, whereas strategic buyers, they're adding that business to be part of that business forever. With a private equity company, at the end of the day, they're interested in the internal rate of return of plus 20% and then an exit in 5 or less years. So the investment horizon changes, and therefore the speed of execution is very different. And then finally, transaction efficiency. From a efficiency perspective and negotiating and all that, the financial buyers are expected to be more experienced because that's their business. They're in the business of acquiring companies and handling and eventually selling those companies. So from a transaction efficiency perspective, you see a larger advantage to the financial buyer than the strategic buyer. Okay. Now, from a motivation perspective, there are countless motivations behind a sale, and it is important for the banker to understand why a company pursued such a transaction. With a strategic buyer bidding a high price, was the company in need of cash and willing to speed up a sale of a non-core business for extra funds? You have to learn about the deals you are analyzing and draw conclusions about how these motivations would impact the valuation. And so I think these are great examples. Say, for example, you're comparing your current transaction to one where say, for example, I'm an oil and gas advisor. I'm an investment banker to an oil and gas company that's going to be selling itself. Well, if I'm conducting a precedent analysis and I'm looking at General Electric, which is a conglomerate and has many assets in different sectors, and General Electric a few years ago decided to exit the oil and gas space, reduce their exposure. So they were really interested in exiting the space much quicker and sell a non-core business. Well, the speed of that execution and also the price that they sold that business at would probably be lower than one at which my client would be comfortable with, because at the end of the day, it's everything for them. It's our business, right? Oil and gas is our business. Whereas for General Electric, they can kind of lower the price they're willing to accept in order to just exit a non-core business. So when you're comparing deals, you also have to understand what are the motivations behind those deals for the seller and the buyer. Now, the type of sale process and nature of the deal should also be examined. For example, auctions, whereby the target is shopped to multiple prospective buyers, are designed to maximize competitive dynamics with the goal of producing the best offer at the highest possible price. Hostile situations, whereby the target actively seeks alternatives to a proposed takeover by a particular buyer, may also produce a higher purchase price. Conversely, a merger of equals would not generate such a high price. And so that's the thing. It depends on, if you're selling to a friendly or a hostile company, are you, conducting a mergers of equals, transaction in which the two companies merge and focus more on preserving cash for the future of that merged company? It depends, once again, on the nature of the deal. And I'm telling you, deal dynamics is key to the precedent transactions analysis. And if you are in an interview and you are going to be talking about precedent transactions analysis, citing off the technical side of that, the EV to EBITDA multiples and, calculating enterprise value and, calculating fully diluted shares, which we'll all talk about, that's the easy side. The mental and both the strategic component of the precedent transactions analysis is really where you can stand out. If you have a strategic mind and understand the thinking behind an investment banker in a company, then you better are able to understand how difficult and challenging in the time invested in the process. You need to invest a lot of time in this, and so that's why from a theory perspective, this is very important. So, purchase consideration. The use of stock as a meaningful purchase of the purchase consideration tends to result in a lower valuation than for an all-cash transaction. The primary explanation for this occurrence is that when target shareholders receive stock, they retain an equity interest in the combined entity and therefore expect to share in the upside. Target shareholders also maintain the opportunity to obtain a control premium at a later date through a future sale of the company. So from a purchase consideration perspective, there are three options. You have cash, you have stock, or you have a mix of cash and stock. And we'll go through this, but for now, essentially, when you're looking at a deal, if the deal was completed on a stock-for-stock transaction, the premium paid will be lower or will be lower in valuation than for an all-cash transaction. And the reason behind that is that with the stock-for-stock transaction, not only are you getting the value of that stock, but then at the same time you're getting the upside opportunity of realizing more potential gains in the future as the shareholders that are being acquired. Okay, so step 2. Locate the necessary deal-related financial information. So locating information on comparable acquisitions is invariably easier for transactions involving public targets due to SEC disclosure requirements. For M&A transactions involving private targets, the availability of sufficient information typically depends on whether public securities were used as the acquisition financing. So this is a quick overview of the different information sources for either public or private companies. So you can pause the video and kind of look through it. But, for key deal terms, you can get the 8-K, the press release, the proxy statements, the schedule, a tender offer. There are all these kind of big key sources of information. So we'll go through the key ones. So the first one is a proxy statement. In a one-step merger transaction, the target obtains approval from its shareholders through a vote at a shareholder meeting. Prior to the vote, the target provides appropriate disclosure to the shareholders via a proxy statement. The proxy statement contains a summary of the background in terms of the transaction, a description of the financial analysis underlying the fairness opinions of the financial advisors, and a summary of the pro forma financial data. If the acquirer is issuing in excess of 20% of new shares of its pre-deal shares outstanding, it will also need to file a proxy statement. So this is the document that is provided to shareholders before a shareholder meeting deciding upon whether to accept an offer or not. And for the acquirer, if they are doing a stock-for-stock transaction and they are exchanging more than 20% of their pre-deal shares outstanding in order to complete the transaction, then they themselves also have to issue a proxy statement to their shareholders to decide whether the deal is approved or not. Okay? There's also a Schedule TO and a Schedule 14D9. In a tender offer, the acquirer offers to buy shares directly from the target's shareholders. As part of this process, the acquirer mails an offer to purchase to the target shareholders and files a Schedule TO. In response to the tender offer, the target files a Schedule 14D9 within 10 business days of commencement. The Schedule 14D9 contains a recommendation from the target's board of directors to the target's shareholders on how to respond to the tender offer, typically including a fairness opinion. There's also the registration statement or prospectus. So when a public acquirer issues shares as part of the purchase consideration for a public target, the acquirer is typically required to file a registration statement and prospectus in order for those shares to be freely tradable by the target's shareholders. The registration statement contains the terms of the issuance, material terms of the transaction, and purchase price detail. These are all different sources that you can really get and have access to as a public company and as an analyst to really learn about the deals. So depending on the nature of the transaction, this is the Schedule 13E3. A going private deal may require enhanced disclosure. For example, in an LBO, if a public company were an affiliate as part of the buyout group, the SEC requires broader disclosure of information used in the decision-making process on a Schedule 13E3. So the Schedule 13E3 is different from the proxy statement or the Schedule TO. For this, it's more related to private companies, and there is a big challenge when it comes to researching precedent transactions in the private space because again, it's private and there's not a lot of financial information out there. But say, for example, a leveraged buyout group is raising debt to take a company private. Well, they can then, they have to issue the Schedule 13E3 and other financial information to really back up the sale of those bonds in order to raise that money and take that company private. So there are still ways of finding information about currently private deals. Okay. There's the 8-K. In addition to the SEC filings mentioned above, key deal information can be obtained from the 8-K that is filed upon announcement of the transaction. Generally, a public target is required to file an 8-K within 4 business days of the transaction announcement. In the event a public company is selling a subsidiary or division that is significant in size, the parent company typically files an 8-K upon announcement of the transaction. Okay. There's the 10K and the 10Q, and essentially the 10K is the annual report and the 10Q is the quarterly report. Most of the people know this, and if you watch Chapter 1, you've also learned about that as well there. There's also private target information. So when a public acquirer buys a private target or a division or subsidiary of a public company, it may be required to file certain disclosure documents. For example, in the event the acquirer is using public securities such as bonds as part of the purchase consideration for a private target, it is required to file a registration statement and prospectus. And so we've already talked about this with the going private in the 13E3. Furthermore, if the acquirer is issuing shares in excess of 20% of its pre-deal shares, a proxy statement is filed with the SEC and mailed to its shareholders so they can evaluate the proposed transaction and vote. And so that's similar to the proxy statement that we talked about initially. Okay? Now, step 3. Sorry, I'm going to take a little bit of water. At this time, maybe you can kind of subscribe to the channel, please, because these videos are really long. Okay, so once the relevant deal-related and financial information has been located, the banker is prepared to spread each selected transaction. Spreading essentially means inputting all the financial information into the input sheets and then calculating the relevant transaction multiples. This involves entering the key transaction data relating to purchase price, form of consideration, and target financial statistics into an input page where the relevant multiples for each transaction are calculated. So now we can talk about equity, enterprise value, and the relevant multiples. So equity value, or equity purchase price or offer value, for public targets in precedent transactions is calculated in a similar manner as that for comparable companies. However, it is based on the announced offer price per share as opposed to the closing share price on a given day. To calculate equity value for public M&A targets, the offer price per share is multiplied by the target's fully diluted shares outstanding at the given offer price. And so we'll go through that and learn about fully diluted shares outstanding. So for M&A transactions in which the target is private, equity value is simply enterprise value less any assumed or refinanced net debt. So there's a difference with M&A transactions in the private sector. Okay, so now looking at the calculation of fully diluted shares outstanding. A company's fully diluted shares are calculated by adding the number of shares represented by its in-the-money options, warrants, and convertible securities to its basic shares outstanding. A company's most recent basic shares outstanding count is typically sourced from the first page of the 10K, the annual report, or the 10Q, the quarterly report. So equity value in this case would be the offer price per share times fully diluted shares outstanding. And fully diluted shares outstanding would be the basic shares outstanding, which can be found in the 10K or the 10Q, or the shares outstanding on Google Finance, plus in-the-money options and warrants, all outstanding, plus in-the-money convertible securities. So let's see how we can calculate fully diluted shares outstanding. Now, the incremental shares represented by a company's in-the-money options and warrants are calculated in accordance with the treasury stock method, the TSM. Those shares implied by a company's in-the-money convertible and equity-linked securities are calculated in accordance with the if-converted method or the net share settlement method. Okay, now the treasury stock method. The TSM assumes that all tranches of in-the-money options and warrants are exercised at their weighted average strike price, with the resulting option proceeds used to purchase outstanding shares of stock at the company's current share price. In-the-money options and warrants are those that have an exercise price lower than the current market price of the underlying company's stock. So to simplify, the treasury stock method assumes that when shareholders or employees exercise their vested options or their options, the proceeds from purchasing those options and exercising those options are given to the company, and then the company takes those proceeds and then tries to buy back shares at the current market price to reduce the dilutive effect of the issuance. So looking at this example, so we have a current share price of $20. We have basic shares outstanding of 100. We have in-the-money options of 5 at a weighted average exercise price of 18. And these are in the money because the exercise price is lower than the current market price. So the exercise price is 18 and the current market price is 20. So the issuance of the in-the-money options, 5 times 18, the options proceeds would be $90, 5 times 18. And then those proceeds are received by the company, and the company takes those proceeds and buys back shares at the current market price. So you then divide that $90 by the current share price to see the amount of shares repurchased from the option proceeds, which is 4.5. So then the difference between the in-the-money options that are existing and the amount that is repurchased following the proceeds that have been received is the net new shares from the options, right? So the in-the-money calculation. And so in this case, the basic shares outstanding is 100, and then we add the 0.5 to get fully diluted shares, if only these two were to be calculated, of 100 and 100.5 shares. Okay. Now, a frequent question is whether in the TSM calculation you include all outstanding options, vested plus unvested, or only exercisable options, which are vested. In the comparable analysis in the last video, our exercisable options that were in the money were considered. So only the ones that were vested. With a precedent transactions analysis, all outstanding options, vested plus unvested, that are in the money will be included. It is the company's future liability which needs to be covered in order to complete the transaction. So one of the key differences between the comparable companies analysis and the precedent transactions analysis is the calculation of fully diluted shares, and this is where the difference is. So when you are calculating in the money's options, do you consider the ones that have been vested or the ones that have not been vested? Will you add up both? So it'd be vested and unvested. So it'd be all outstanding options. And the reasoning behind that is that when you make a commitment to vest a certain amount of options in the future, that's a future liability to your employees. But when a company is being acquired, the life of that entity will end once the transaction is completed. So the banker assumes that, all of those options are to be vested now in order to complete the transaction, right? So all of those options are now included, even the ones that are unvested, right? And so that's really important because it has a much more dilutive effect on fully diluted shares outstanding. Okay. Now, in the money converts are converted into additional shares by dividing the convert's amount outstanding by its conversion price. The convert is treated as equity and included in the calculation of the company's fully diluted shares outstanding and equity value. The equity value represented by the convert is calculated by multiplying the new shares outstanding from conversion by the target's offer price. Accordingly, the convert must be excluded from the calculation of the company's total debt. So essentially, if you have $150 in the money converts, we can divide the convert amount, the outstanding, by the conversion price of $15. To calculate 10 new shares, which will be added to fully diluted shares. So here's an example. So same thing, we have a current share price of 20. We have basic shares outstanding. And now we have convertible securities. The amount outstanding is $150. And so the conversion price for those $150 amount outstanding is 15. And it's very easy. The if converted method is very, very easy. All you have to do is divide that amount outstanding by the conversion price to get the new incremental shares. And so that 10 is then added to fully diluted shares, or added to basic shares outstanding to get fully diluted shares. So that's how you calculate the in-the-money convertible equity securities. So in-the-money options we use the treasury stock method, and in-the-money convertible securities, we use the if-converted method. Okay, now talking about the purchase consideration. This is very important. In an M&A deal, the purchase consideration refers to the mix of cash, stock, and/or other securities that the acquirer offers to the target shareholders. The three primary types of consideration for a target's equity are all cash, stock for stock, or a mix of cash and stock. In an all-cash transaction, the acquirer makes an offer to purchase all or a portion of the target's shares outstanding for cash. This makes for a simple equity value calculation by multiplying the cash offer price per share by the number of fully diluted shares outstanding. So this is the easiest transaction to understand when it's just a cash deal, and this is usually when the acquirer is a very big company and the target is a very small company, and they can really just pay all cash for the deal. Now, in a stock-for-stock transaction, the calculation of equity is based on either a fixed exchange ratio or a floating exchange ratio. The exchange ratio is calculated as the offer price per share divided by the acquirer's share price. And so I will pause right here and just say I actually made a separate video. I stopped midway when reading this chapter, and I'm like, look, I'm going to rush through this on this whole overview video because, of time, but I've made a separate video talking about the stock-for-stock transaction. So it's on my channel already. It's been published, and it's a very good comprehensive guide to understanding the stock-for-stock transaction and going through a real full example of this. Okay, so the exchange ratio is calculated by taking the offer price per share divided by the acquirer's share price. Okay, a fixed exchange ratio. So there are two types of exchange ratios. There's the fixed and floating. Now, the fixed is a ratio of how many shares of the acquirer's stock are exchanged for each share of the target stock. The ratio is fixed, as the name suggests. In a floating exchange ratio, the number of acquirer shares exchanged for target shares fluctuates so as to ensure a fixed value for the target shareholders. The ratio floats. So as the name suggests, it is a floating exchange ratio. And so the floating exchange ratio is also known as the fixed price exchange ratio, because with the exchange ratio floating, the fixed variable is the value of the deal. With the fixed exchange ratio, the fixed variable is the exchange ratio itself, right? So if the company's stock changes in value with the fixed exchange ratio, the overall value of the deal changes. But if the company's, either the target or the acquirer's company shares change in value with the floating exchange ratio, the exchange ratio changes and the value of the deal stays fixed. So that's why, the floating exchange ratio is preferred for the target and the fixed exchange ratio is preferred for the acquirer. Okay? So in general, a floating exchange ratio, the fixed price, is used when the acquirer is significantly larger than the target. It is justified in these cases on the basis that while a significant decline in the target's business does not materially impact the value of the acquirer, the reciprocal is not true. It is more common to structure a deal using a fixed exchange ratio. With floating, the buyer assumes the full risk of price volatility, because at the end of the day, with floating, the value of the deal stays the same, so the buyer is paying the same amount, right? And if it takes more shares and they have to issue even more shares to really meet that exchange ratio, then it can be much more risky. So that's why, being the buyer and being the person who sets out the deal from the beginning, you'll see a lot more fixed exchange ratios than floating exchange ratios. Okay? So how does this exchange ratio fit into an acquisition? Once an investment bank determines the per share value of the target or equity value, you can calculate the exchange ratio, right? So you can take your exchange ratio, it's the target's offer price divided by the acquirer's share price, and you multiply that, and you get your offer price per share. And so that can then be multiplied by the target's fully diluted shares outstanding to calculate the equity value or the value of the deal from an equity perspective. And then you can, of course, add the amount of debt and calculate the enterprise value as well. So a purchase consideration with a mixture of cash and stock is relatively easy to understand once you understand the stock for stock transaction. Consider the $10 per share for 1 million fully diluted shares, funded 50% with stock and 50% with cash. The cash offer would be $5 per share. It's 50% of $10 a share, multiplied by 1 million shares for a total cash payment of $5 million. Now, for the stock component, you would calculate the exchange ratio, right? So 50% of the $10 a share offer price would be $5, and you divide that by the acquirer's share price, right, which is 17. So you divide 5 by 17 to calculate the exchange ratio, which is 0.29412. Okay, this means that for each share held of the target company, the shareholder will receive 0.29412 shares of the acquirer's stock. Check this. Now we can actually check this to see if it makes sense. So we take our exchange ratio, we multiply it by fully diluted shares of the target company, and then we multiply it by the value of the acquired shares, the shares that are being given. And once we calculate, we multiply 0.2 times a million times 17, we get around $5 million, which makes up the remaining portion with the cash payment of $5 million for a total of the $10 million offer price for the company. And so that's much easier. And really, as long as you understand the stock for stock transaction, you can understand the cash and stock mix. And once again, if you need more explanation on that, I would recommend that you check out that video first and then comment below to see if I can kind of answer your question. So now, enterprise value. Enterprise value is the total value offered by the acquirer for the target's equity interest, as well as the assumption or refinancing of the target's net debt. It is calculated for precedent transactions in the same manner as for comparable companies, comprising the sum of equity, net debt, preferred stocks, and non-controlling interests. So our enterprise value is the equity value plus total debt plus preferred stock plus non-controlling interest minus cash and equivalents. And for the key difference in the calculation of enterprise value between the comparable companies analysis and the precedent transactions analysis originates from the equity value side, right? So now we're multiplying the unaffected share price plus the premium paid, right, for the total offer price per share times fully diluted shares outstanding. So the equity value in the enterprise value calculation for precedent transactions analysis would be the offer price per share times fully diluted shares instead of just the current share price times fully diluted shares outstanding. Okay? So now the key transaction multiples used in precedent transaction comps mirror those used for trading comps. Equity value, as represented by the offer price for the target's equity, is used as a multiple of net income, and enterprise value is used as a multiple of EBITDA, EBIT, and to a lesser extent, sales. In precedent transactions, these multiples are typically higher than those in trading comps due to the premium paid for control and/or synergies, and we talked about that at the beginning, right? Whether it's a financial or strategic buyer, and whether there are synergies, the multiples are higher than in the comparables companies analysis. Now, multiples for precedent transactions are typically calculated on the basis of actual last 12 months LTM financial statistics available at the time of announcement. The full projections that an acquirer uses to frame its purchase price decision are generally not public and subject to a confidentiality agreement. So as an outside analyst, you really just have to kind of look at the numbers and try to interpret to see how that company was approached the thinking of its sale or purchase. Okay, so for equity value multiples, you have the offer price per share to the last 12 months EPS or equity value to net income, right? So the common equity value multiple in both comparables and precedent transactions analysis is equity value over the last 12-month net income. For enterprise value, you have EV to EBITDA, EV to EBIT, and EV to sales. So these are the common multiples, and there are other premiums. So I would talking about the chapter 1 video, I spent a lot more time looking at individual sectors and sector specific multiples. You have EV to maybe reserves for mining companies, you have EV to the amount of ore milled or the amount of ore produced or whatever it is. So there are more sector specific multiples, but just for the general kind of introductory analysis of the precedent transactions approach, the common multiples for equity value are equity value to net income, and for enterprise value, they're EV to EBITDA, EV to EBIT, and EV to sales. And just to talk about this, I think it's really important to understand that for enterprise value is unbiased statistic measure relative to the capital structure of the company. So enterprise value includes both equity and debt, right? So when you're comparing a company, it's better to compare it through enterprise value than with equity value, because with equity value, there's a bias towards the capital structure of the company, right? And so these multiples, when you're using EBIT, you can't use a equity value to EBIT multiple. That doesn't make sense because equity value is affected by the debt structure, whereas EBIT is unaffected because it is pre-financing expenses. So for multiples, anything including EBIT and above, so EBIT and above the income statement, should be used with enterprise value, right? Because it's unaffected by financing costs. After you include interest expenses, then you use the equity value. You can't do enterprise value to net income because that wouldn't make sense. Enterprise value is not affected by the capital structure, but net income is because it includes the effect of the interest payments, right? So you need to remember these when you are conducting your multiples analysis. Now, the premium paid refers to the incremental dollar amount per share that the acquirer offers relative to the target's unaffected share price, expressed as a percentage. As such, it is only relevant for public target companies. In calculating the premium paid relative to a given date, it is important to use the target's unaffected share price so as to isolate the true effect of the purchase price. So you can look at the unaffected share price maybe going a week or two before the announcement of the acquisition, because if you were to look the day of or the day before, maybe there are some people who got wind of the deal and there was a leak and maybe the share price is not truly reflecting its unaffected share price. So go a week back and take that number, and then you can of course take the offer price. You divide the offer price by the unaffected share price, and then you subtract it by 1 to get the premium paid and percentage wise, right? So synergies. This is a big topic in M&A. Synergies refers to the expected cost savings, growth opportunities, and other financial benefits that occur as a result of the combination of two businesses. Consequently, the assessment of synergies is most relevant for transactions where a strategic buyer is purchasing a target in a related business. Synergies represent tangible value to the acquirer in the form of future cash flow and earnings above and beyond what can be achieved by the target on a standalone basis. Therefore, the size and degree of likelihood for realizing potential synergies plays an important role for the acquirer in framing the purchase price for a particular target. So synergies is a big topic. It's a difficult analysis to really determine how much synergies can be realized through a deal, but the common ways synergies are realized are through increased revenues or reduced costs if you're eliminating kind of similar departments, right? If you are acquiring another mining company and they both have accounting departments and HR departments, then you can kind of cut on back office costs. And at the same time, through economies of scale and relative industries, then of course, you can benefit from that as well if you increase your market position. So there are a lot of potential synergies. Usually it's the strategic buyer that realizes that synergy, but if a financial buyer already owns a company in that respective sector, if a private equity company already owns a mining company in their portfolio, then they can merge the two companies once they acquire the second mining company, and they can also realize synergies. But more often it's the strategic buyer that realizes the synergies. Okay. Now, transaction multiples are typically shown on the basis of the target's reported last 12 months financial information. For a deeper understanding of a particular multiple paid, the banker may calculate adjusted multiples that reflect expected synergies. This typically involves adding the full effect of expected annual run rate cost savings synergies to an earnings metric in the denominator, right? So when you're looking at precedent transactions or the current transaction that you're analyzing, you want to adjust for the synergies. So if the company projected synergies of 200 million and therefore, or cost reductions, when you're looking at the EBIT measure, you want to adjust for that cost reduction. So EBIT actually increases a little bit, and therefore the multiple is actually lower or higher depending upon that adjustment, right? So consider an example where a transaction with a purchase price of $1.2 billion is being analyzed. If the last 12 months EBITDA is 150 million and expected synergies is 25 million, the EV to EBITDA multiple changes significantly once adjusted for those synergies. So the initial EV to EBITDA multiple would be 8x. But if you add the synergies so that EBITDA increases, from 150 million to 175 million, then your EV to EBITDA multiple actually declines to 6.9x. And that's a big difference, especially when you're comparing averages and medians. So you want to make sure that you're adjusting for synergies. And this is something that a lot of students forget to do. Okay, now step 4. Now, as with trading comps, the next level of analysis involves an in-depth study of the selected comparable acquisitions so as to determine the most relevant for valuing the target. As part of this analysis, the banker re-examines the business profile and benchmarks the key financial statistics and ratios for each of the acquired companies, with an eye toward identifying those most comparable to the target. So once you benchmark the comparable acquisitions and you calculate the means and medians of those respective multiples, you can finally then, step 5, determine the valuation. In precedent transactions, the multiples of the selected comparable acquisitions universe are used to derive an implied valuation range for the target. While standards vary by sector, the key multiples deriving valuation in precedent transactions tend to be the enterprise value to last 12 months EBITDA and equity value to net income. So those are the key multiples that are used to derive valuation. So it's either EV to EBITDA or equity value to NI, net income. Therefore, the banker typically uses the means and medians of these multiples from the universe to establish a preliminary valuation range for the target. Right? A common red flag for precedent transactions is when the implied valuation range is significantly lower than the range derived using comparable companies. And this makes sense because we talked about that premium that's paid for acquiring a company relative to the current market valuation of that company, whether it's through synergies or because of a strategic buyer. The multiples should be higher. And if the implied valuation range is lower from the precedent transactions than the comparable companies analysis, then you probably did something wrong, or you kind of missed some information. So that's really important. And now, as well with this, once you have calculated the range, if you say that EV to EBITDA ranges between 6.5 and 7.5x for this respective industry, for this respective transaction, you can then take the EBITDA of the current company that you're analyzing and put it within that range and multiply it by 6.5 and 7.5. Then strip away net debt to calculate equity value, and then divide it by fully diluted shares to calculate the implied share price between X and Y, right? And so that's how you really calculate the valuation. And of course, you can include other sensitivities in order to kind of account for other changes in the environment. But that's really how to determine the final range valuation through a precedent transactions analysis. So, quick overview: what are the advantages of the precedent transactions analysis? What's market-based? Based on actual acquisitions and premiums paid by competitors. It's also current. Recent transactions reflect current M&A market. Also, the relativity. Multiples provide easy reference points. Is the simplicity of the analysis. So few multiples anchor valuation, so it's very easy to conduct a valuation using the precedent transactions analysis. And the objectivity, precedent-based and avoids making assumptions about future performance, which is very, very good, because with the discounted cash flow model, it's all about future assumptions. You're assuming long-term growth rates and you're assuming discount rates, and that can kind of skew your results if you're biased in the current market. So this provides a lot more objectivity. The disadvantages, however, well, it is market-based, and based on that, the multiples may be skewed due to biased market conditions. Also, there's a time lag. If it had occurred in the past and it is not reflective of prevailing market conditions, then that might be a problem. And the time lag, think of it as if I'm comparing a current transaction to one post, the 2008 financial crisis, it would be unfair in 2017 to compare it to a transaction in 2009. So there is a time lag, and there are changes in the market due to the timing factor. So that's a big disadvantage. Also, the question is there an existence of comparable acquisitions? Is there truly a similar acquisition? It depends, once again, on the experience of the banker and whether they really choose the right ones. Also, the availability of information. Information may be insufficient, and for most private deals, it's susceptible. So there are a lot of potential errors in information, especially when you're analyzing private deals. And finally, there's acquirer's bias for valuation. So a multiple paid by a buyer may be based on expectations of future performance rather than current last 12 months financial performance. So if you're going through your precedent transactions analysis and you see that one previous transaction, like the medians, the average, the EV to EBITDA and the equity value to net income of that respective transaction is just completely off, like significantly higher than everything else, it's probably because for that respective buyer, they were really, really optimistic about the future and decided that, yes, we can pay a very high premium just to really get this business and add it to our current portfolio. So once again, there are a lot of biases that might exist for companies who, want to play the whole, I want to be the biggest company in the world kind of game, and there's a lot of egos and all of these. So there are a lot of still risks, and overall the multiples that are paid are susceptible to different things. So that's pretty much it. Hopefully you did find the video helpful. If you did, please like and subscribe to the channel for more videos. If you have any questions, I would love to answer them. Please comment below and I'll be sure to get back to you as soon as possible. And as well, I would recommend that you watch, chapter 1, where we talked about the comparable companies analysis, and chapter 3, where I'm going to be covering the discounted cash flow model, and chapter 4, I'll be talking about the leverage buyout model. And also, I'm going to be making some videos with some questions with regards to what we're talking about this. So I do recommend that you check out the chapter 2 questions for this respective topic for the precedent transactions analysis, and hopefully that can kind of test your knowledge about the things that we just covered right now. As always, if you're interested in the financial markets, I do recommend that you check out my Seeking Alpha profile. I publish a lot of research on there, so I've provided a link in the video description. And if you want to buy the textbook for what I'm working off right now, I've provided the Amazon link in the description where you can buy the textbook as well. As always, guys, thank you so much for watching. Congratulations on watching such a long video, and good luck to you guys in the future. Thank you.